When a stock stops trading, most people assume the story is over. But in reality, a trading halt doesn't end ownership. It doesn't erase shares. And it doesn't automatically resolve what investors hold. In this episode, we look at what happens after trading stops, using MMTLP and its conversion into Next Bridge Hydrocarbons as a case study, to better understand ownership, settlement, and why uncertainty can persist long after the halt itself. This is not an argument about intent or blame, it's an examination of process. A trading halt does one specific thing: it stops buying and selling on an exchange. What it does not do is B, cancel ownership, eliminate shares, or resolve outstanding positions. This distinction is critical. Trading, ownership, and settlement are related, but they are not the same thing. When MMTLP was halted, trading ended, but ownership did not. After the halt, MMTLP holders were converted into shares of Next Bridge Hydrocarbons, a private company. That means investors didn't suddenly hold nothing. They held shares, just not shares that trade on a public market. This is where confusion often begins. People tend to associate ownership with liquidity, but liquidity is a feature of markets, not ownership itself. You can own something that doesn't trade. Private company shares are a common example. Publicly traded shares have an exchange, continuous price discovery, visible liquidity. Private company shares do not. Once MMTLP converted into Next Bridge shares, there was no public market, no quoted price, and no immediate way to sell through a brokerage platform. The shares still existed, but the mechanism for trading them did not. Even without trading, shares are still recorded. Ownership is tracked through brokerage records, transfer agents, and internal settlement systems. However, when a security stops trading and transitions into a private structure, reconciliation becomes more complex. There's no daily trading activity to naturally resolve discrepancies, no price movement to force settlement, and no market mechanism to close positions automatically. Time alone doesn't solve that. Many people assume that once a halt occurs, everything sorts itself out. But without a trading venue, liquidity, or a forced settlement event, open questions can remain unresolved for extended periods. This isn't unique to MMTLP, it's a broader structural reality in situations involving delistings, spin-offs, and halted securities. For many investors, the expectation going in was optionality: the option to buy, the option to sell, the option to transfer or exit. After the halt, those options narrowed significantly. That mismatch between expectation and outcome is where frustration often arises, not necessarily from what was owned, but from what could no longer be done with it. Understanding that distinction matters. The mechanics seen here aren't unique. Similar questions arise in corporate spin-offs, delistings, bankruptcies, and halted securities across markets. Each case looks different on the surface, but many share the same structural challenge. What happens when ownership continues, but markets stop functioning as expected? This episode doesn't attempt to answer every question. Instead, it highlights an often overlooked reality. Trading can stop while ownership continues, and the gap between those two states can be uncomfortable, confusing, and unresolved. Understanding how that gap forms is essential to understanding modern market structure. In the next episode, we'll continue to zoom out, looking at how settlement, liquidity, and short interest interact when markets are under stress.